I'd like to just go around the horn to start and talk about what changed a week ago Tuesday, how much of a thesis is getting rewritten, and how much is just carry through from trends that were in place prior. Maybe, Ann, you can kick us off.
Well, so I think there's still a lot of trends that are the same with regard to inflation, notwithstanding today's CPI number that seem to indicate that we're kind of hitting a bit of a stasis, if you will, on the downward trajectory. Fed policy is still towards easing and rate cuts, and I know we'll probably spend some more time on that. The large backdrops of global uncertainty and the important reshoring and friendshoring activities are all the same. What has changed is potential policy changes with the election of President Trump and Republican Senate and House. And I think that's going to cause investors to be more wary, notwithstanding the big stock market move we saw, but certainly the bond market. And I think what we're going to see is some more volatility, which was also happening already, and we're going to see more of it.
Just really quick, you were surprised by this bounce in equities over the past week, yes? Fair to say?
I would say that, yes. I was not surprised that we saw a reaction in the markets, but the magnitude of the reaction. And I think a little bit of that is pulling forward some expectations of tax policy changes and the effect of the continued tax policies of President Trump and the tax cuts that will stay in place and other more growth-oriented policies of the Trump administration, particularly deregulation. On the other hand, it's offset by, of course, the bond market reaction, which was based on the reflationary concerns that we see.
Joe, how about you? You also have the advantage of looking at this from a somewhat outsider's view, rolling in some FX effects and so forth as we look forward, right?
Yeah, so back to your question, if I could, we ran a number of scenarios that could have happened around last week. The good news, I think, is the election wasn't contested, where you would have potentially seen more volatility potentially in markets. We were ready in case there was a downdraft in terms of equities to be able to buy, so we had a liquidity ready for that.
Were there targets you had in mind?
Well, we're slightly underweight, I would say, passive in the markets, so that would have allowed us to sort of buy indexes, I think, more than specific baskets of stocks. I think looking forward, the challenge we always have is, we're a long-term investor, but we're tactically looking at the short term as well to make sure we're agile and we can maximize our returns. Picking up the earlier point from Anne, I think we've seen our fixed income book was hit a little bit immediately after the news of the Trump success. I think for us, probably the biggest question back to your outsider point is how much of an outsider may we become? We have $120 billion invested in the US. It's a big part of our business. So above and beyond FX, translation, et cetera, it's really our freedom to operate and our ability to still be a preferred investor in an area where we can provide long-term capital.
So what would the constraints be on that, on you guys?
Probably taxation changes would be the most immediate one I would think of. We operate around the world and we always try to have a fairly benign, neutral approach to taxation. If the view was the profits we make in America, when we translate them back into Canada, become a taxable entity, even a small tax percentage on those numbers, it's quite a lot of money.
Lalo, how about you? How did last week look and what changed?
So not a lot changed in the sense that the vast majority of our client base and our assets are longer term. So we have a decent amount of, we'll call it $500 billion globally, a decent amount in retirement assets, and then another part in foundation, endowment, healthcare type of assets. So really, really long dated. But we tend to think of our portfolios in terms of three broad risks. So corporate risk, equities and bonds, rate risk, where things are, and then real assets. So hard assets, real estate's infrastructure. And all three are ultimately impacted by any types of policy changes. So the uncertainty as to where to allocate capital really came into play. We were somewhat neutral with regards to benchmarks, because all of them have some kind of a global equity benchmark. But if you take a step back and think of corporate risk, what would that do with regards to taxation and policy? What we indicated there. For real assets, some of the areas that we're looking at that opened up over the last few years were infrastructure related due to the Inflation Reduction Act, and could any of those be repealed? So what does that mean on a go-forward basis? And then for rates, rates are where they are today because of inflation. And if there are tariffs, could that keep inflation high? So lots of uncertainty, but all with regards to policy.
So on that last point, you really are starting to look at what's possible through executive action and what will take Congress's at least, I guess, tacit approval, and then sort of the time difference on those two dynamics, right?
Yeah, some of us were talking about this, behind. It was really just examining, scenario planning, what could happen if things change, how are your positions, how are your portfolios positioned effectively? Because the policy changes are really what could impact how we allocate capital. So it's the uncertainty around that, and just making sure that as we look for opportunities, they're more centered around the longer term types of themes.
And do I have this right? Do you think we're past peak uncertainty?
I think that volatility will be with us for a while. We're in an interesting time at this point. We've come through the 40-year bull market in bonds. It ended in 2022. And we've entered a period of time where we're really in fixed income land. We're in a trading range. And so this sort of heightened sense of volatility that's going to run in, using the 10-year Treasury as an example, it's going to run, say, between 3.5 and 4.5 for a while. And in that kind of world, what you see is elevated levels of fixed income volatility relative to equity volatility. And right now, that is going to, we would anticipate, continue. With regard to equity, equity volatility will probably remain more benign. The challenge is risk premium there is much lower than it was. And so we're just going to continue to see these kinds of trading paradigms go on, which is not a pattern that we're really used to seeing if you take a long-term view of the marketplace.
Right. So as a result, you think it's a good time to be a credit investor, right?
Absolutely. Fundamentals are very strong right now for credit. And recognizing that we have tight spreads, relatively speaking, but you're looking at interest coverage ratios, and you're looking at leverage ratios across the corporate spectrum, and they're in a very strong position. So it's a good time to be a credit investor. I'll also follow along Olaolu's comments, which are real estate and infrastructure is well placed. Real assets perform well in this kind of environment as well. So I think it's a good time to be a selective investor. You do have to continue to do your homework.
When we say hard assets, what kinds of things do you gravitate toward the most? What's most attractive in the way of infrastructure, hard assets, real estate, that kind of thing?
I mean, there was a lot of opportunity with regards to clean energy opening up here in the U.S. Again, the policy changes have somewhat made that a little bit more critical. We have to really sift through to be able to find that. But all the clean energy type of opportunities was definitely favorable. The other aspect, just to parlay a little bit, picking up on some of what Ann was talking about, was private credit. So there's about $45 billion. It's a floating rate asset class, whether it's direct lending or structured credit or opportunistic. So back to being a good credit investor, it's either in public markets or private. And there's a lot more opening up in the private credit space as well, in addition to the real assets.
Joe, thoughts on that? And I guess given everything we've talked about so far, does it, either whether it's valuation or policy uncertainty, does it make the U.S. more or less attractive relative to your other international options?
So the only thing I'd add to what was already said is, we always try to get enough balance in the portfolio around the different opportunities that have been described. So we've added recently to our credit portfolio. Spreads have certainly tightened up. So I think from our point of view, we're trying to say, do we want to keep on investing in that area versus other opportunities? I think the issue with the US is pretty regularly reviewed by us, and we're constantly saying, is there an alternative? Are there other parts of the world where you would get a similar risk-adjusted return across the types of asset classes that just been mentioned? And it's pretty tough to find other parts of the world where it stacks up quite as obviously for us. Now, we do want to get a balance also internationally around the portfolio. We've been striving more for a 50-50 balance between assets in the Americas and other parts of the world. I mean, to be honest, we tend to keep coming back to more of a 70-30 mix, which actually just shows the resilience and the strength of the US market.
Wow. Who would be our biggest competition?
Probably for us, we've run through different phases, but I'd say at the moment the area we would look at are countries that actually have rare earth metals, which is an interesting spot for us. Places where we can help with the climate transition around clean energy. So that can be parts of Latin America as well as Europe and the Americas. It tends to perhaps translate more to the theme that we're attracted by and where we can execute that. And the other thing to say is there's also a question of the speed of execution, particularly when we're in private markets. So countries which have very long permitting processes and delays probably aren't quite so easy to operate in.
On that note, and what's getting so much attention is this push on government efficiency. Elon Musk and Vivek Ramaswamy are going to lead this non-government agency, but looking for cuts. Is the more powerful dynamic that it improves the deficit spending and is helpful for yields, or the macro risk on employment and overall economic activity?
So one of the challenges for a fixed income investor, particularly with regard to rates, is there's just so much fiscal spending going on, $2 trillion a year deficit spending. And even if it were to be reduced by some fraction of that, we're still talking about continued deficit spending, and that's going to continue to put pressure on the rates market because of supply and demand imbalances. And yes, we do have a strong international buyer still, but not as strong as it was. And so you're going to have some crowding out effect. So it's very important to see if there can be the other side managed, which is to reduce the spending. So I applaud, as a bond investor, the effort to try and manage fiscal deficit spending. But it's going to have to be significant in order to make a dent, especially when you're looking at the balance with regard to tax policy. And right now we know and believe that the Trump tax cuts will continue. The question is, will they be added onto with other tax cuts or other types of tax programs, which will continue to reduce revenues to the fiscal side of the balance sheet? And so that's the question for bond investors, which is one of the reasons I think they're very concerned right now, is because they're pricing in this sort of inflationary backdrop, additional fiscal spending, not offset with revenues. And so the market's really taking a very questionable look at all of this right now, hence the volatility.
Right. Kind of raises a question that got kicked around today, Olaolu, and that is, would you rather have corporate tax stay where it is, but get assurances on tariffs, or take it to 15 and let the administration go wild on tariffs, even as a negotiating tactic? What do you think the market's preference would be?
That's a very, very difficult one to pick, right? Because if you think of corporate tax cuts and just looking at the equity markets are at peak valuations. So peak valuations today, even without the tax cuts. So presumably, if that comes into play and becomes more widespread and we see a broadening of the performance in the equity markets, right now it's a little bit concentrated, it's great for equities. But then the flip side again, if you start thinking of things like tariffs and inflation, those do affect the companies. So could the benefit of one offset the benefit of the other one? It's just hard to call. We're really, really looking to see what the details are, because policies are great in theory, but it's the execution and what that really means.
Yeah, we're definitely in the theory part of it right now. The prior segment that David and Andrew did, Joe, regarding AI and just the wave of innovation that's going to be headed our way in the next couple of years, do you have favorite ways to play that? Or is it still too much of almost a novelty test case to get serious about? beyond picks and shovels, I should say.
Yeah, so I guess we try and play at both ends of the spectrum. So we'll invest in larger businesses that are able to monetize, we assume, more immediately some of the opportunities. And we have a venture growth team that'll work with US-based funds to find the emerging, perhaps more niche AI businesses, which may be disruptors and able to create a disproportionate value. I think the biggest question which has been raised, but jury's certainly out on for me, is the CapEx is so large, it's really hard to translate that into what is the benefit and the return on that investment. And I think that's pretty vague at the moment. And if you can't start to nail that down soon, I think there's probably some logic in pausing rather than being very active.
That gets to some really interesting charts that have made the rounds last couple months, and one looks at AI spend as a percentage of CapEx, which is comparable to Cisco Nortel in 2000, IBM peak revenue in 69. Does it feel that toppy?
Well, I think we're actually in really early innings of the artificial intelligence world and the paradigm in terms of both investment and in effect. We will, over the course of time, see the productivity increases and the benefits. Right now, we're really at the very early parts of investment. And that's still all the build out, whether we talk about infrastructure build out for data centers or power that's going to be needed to power artificial intelligence efforts. CapEx is in its early days. And I think this has got a long multi-year, certainly even multi-decade potential in terms of its impact on productivity and investment. So I don't think we're anywhere near getting topped out on the investment. I think this has got a long way to go.
Plus, if you're right and we are in this sort of reshoring phase, it kind of gives companies cover, does it not, to go pedal to the metal?
Absolutely. And again, the productivity impact, we haven't even begun to see. I think if we look back to a similar time frame where we're making large investments in computer systems and the like, you look in the 1990s, for example, and you had this enormous spike in productivity. By the way, we also had a little bit of inflation, but it was completely manageable against that growth trajectory that we were also on. And that's a pretty healthy environment for markets in general, credit, equities, and these other kinds of assets that we've been talking about. So if we were to see that kind of paradigm again, which is really what we pretty much expect, then I think we're gonna see a very bright future for artificial investment or artificial intelligence investment.
You think we have a crack at recreating that?
So I was going to say, there's a lot of headlines around artificial intelligence, and it makes sense, and it's great. But if you really look at the technology spend for companies, like over 10% of it is more cybersecurity. So if you start thinking of those types of companies, again, very many of them that we found with regards to private equity venture type investments, cybersecurity is big and growing. So almost the security of everything. But more and more, the cost of a data breach can really affect the company. And more of that spend is going into those types of technologies.
They're going to wrap us here in a minute, but I thought before we left, we could, if you're willing to share your favorite out of consensus idea. Does this something come to mind, Ann?
Out of consensus is that the rates environment will stay within a trading range for quite a period of time, maybe even more than a couple of years. So that's pretty out of consensus. Somewhere between 3.5 and 4.5 around on the 10-year for quite some period of time.
For a matter of years, plural.
Potential years.
Wow. Joe?
It's probably more out of consensus for us as a pension plan, but I think I would be really looking at our fixed income bond portfolio, it's about 90 billion, and saying, is it actually performing the way we want? In other words, it's giving us that balance to some fluctuations we see in the equity book. Because if it isn't, we should lighten the load.
Olaolu, how about you?
I don't know necessarily if this is out of consensus, right? Because we are seeing, even though equity markets are at peak valuations and more capital is flowing there, we're moving more private. So we are seeing opportunities there. I actually think, despite where markets are, we will continue to see capital flows, and for us in the private market space. And
do you think that suppresses IPO activity, or the urgency to go public kind of lessens?
If we have looser regulation, we may see more IPO activity. Right. So that could also be beneficial.
Yeah.